Good morning, everybody, and welcome to today's episode of Derek Invest. I'm your host, Derek Miller. And what I want to talk about today is we're going to look at some commodities, we're going to look at some crypto, and I want to look at a few more of the tech companies that are involved in AI and also being very actively traded by professionals and institutions. How do you identify if they're being actively traded by professionals and institutions? Really, really simple: volume. All right. When there's certain levels of volume occurring and they're occurring day in and day out, these are companies actively in play on an institutional level. I always sort of have a thought for the day, and I think I'm going to start calling it that. So the thought for today: I watch all day as I scroll through social media, and I don't do a ton of it in a given day. But when I scroll through social media, I see all these guys, most of them young guys, talking about levels and how they're teaching a course, and there's this level here and there's that level there, and there's a Fibonacci retracement, and there's the moving average, and there's all this. And a lot of times when you watch me, you'll hear me poo-poo that stuff. Say, look, you're looking at lagging indicators pretending that they're forecasting mechanisms, and they're not. They're lagging indicators. But this is what I want to tell you. Let's pre-assume that all of those things are true, that you're able to use a lagging indicator to forecast. Never been done in history, but let's pre-assume that you're able to do it for argument's sake. The fact of the matter remains, and this is the thought for the day: if you don't know yourself within trading, if you don't have a set of rules that you follow where you know exactly what you're going to do with your cash management, your risk management, and your investment management, all of those indicators, pre-assuming they work, will not matter. You will fail. Understanding the mechanics of a market, that's step one. And that's not easily done. There's a lot of people out there pretending that it is. I've been trading for 5 years. After 5 years, I think I had only blown my account up once. And I would say I was okay in the trading and investing world. And I did it right. I didn't go out there and jump directly into the 25-foot surf, right? I did it the right way. By the time I hit 10 years, I'd blown up my account 3 times, but I had become a master at that point. I've been doing it now for 25, and you sort of even transcend that master status at a certain point because most of it becomes very intuitive, as do the rules that I follow become very intuitive to me. But to be so let me circle back. So to circle back to these moving averages, these mechanics, support, resistance, breakouts, volume, all of these things, all of that is completely useless if you don't know yourself in the trading world. Let me give you an example. So for me, right, I grew up as a wrestler. All right, probably the most painful sport that exists. Real wrestling, obviously, not WWE. It's a sport that it's all up here. I mean, wrestling's all up here. The mechanics of wrestling, you can go online. There's lots of you'll see guys pull off some pretty cool stuff. But the fact of the matter is, if you stick to the basics in wrestling and you are in your better conditioning and you're willing to take more pain than the other guy, he can never beat you. It is a sport of intelligence, of pain resistance, but it builds the mind more than anything because you learn how to just ignore pain. So you have to understand something, and when you're dealing with me, and anyone that's ever done a CrossFit workout will tell you this: CrossFitters love to have me in their workouts because when it starts to get really painful, that's when I really come to life. That's my pleasure space. When it starts to get like, oh, and people start really, I feel the same way, just so you know. I am in the same pain everybody else. I am pushing as hard as everybody else, but that's when I start to make jokes. That's when I start to I like it. I want it. That's my personality. That's who I am. So when you say, so you take that into a trading world, right, where other people set limits at support or set limits at resistance, I don't believe in that because I know that's built for 90%, 95%, 99%. I don't know the percentage, an extremely high percentage of traders, they can't take it beyond that pain point. That pain point is also a pain point that that a lot of other people recognize. That's why you often see it pop through a few points and pull back, right? False breakouts. False breakouts happen to the upside and the downside. So that's just, but sometimes the entire range is false. And that's where mechanics come in. You have to know how to do that. But if that's my personality, but your personality, and if you talk to psychologists and all, they're going to say, well, he must have had a traumatic past, blah, 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 blah. I did growing up. And maybe that is why. I have no idea. But I know that about myself. Okay. Now, if you're the kind of person that enjoys yoga and peace, first off, being a trader may not be for you, but it may be exactly for you, because the psychology behind it all, you may find very interesting, and you may be able to really sit in that and just relax as things occur. I have that ability as well, to just relax. I don't get wound up, right? So, but if you're that kind of person, volatility is not going to be your bag. You're probably going to be somebody who is looking to swing trade, hold positions for a couple weeks, a month. You're looking for those long trends. You're just going to make sure things don't break. As long as they're not breaking, you're going to ride it, right? Whereas me, I like it. So I like to go a lot shorter. I like it to be fast. I like volatility. These are the things you have to know about yourself, and you have to learn about yourself before you start actively investing in trading. So for all of you out there that are dealing with any mechanics in the market, I don't care what they are. I don't care if it's order flow. I don't care. I know a lot of guys follow the Greeks, and I'm not telling you these aren't tools to utilize. Even all of the indicators I just mentioned are all tools to utilize if you choose to. I'm not telling you not to do that. But if you don't know yourself, if you don't have a plan that is designed for you based on your personality, based on how much money you have, based on how much risk you're willing to take, based on what investments you should even be looking at, and then how much money are you putting into investing? How much should be left in cash? How quick are you on the draw? How early do you get out? If you don't know this stuff, it's not going to matter. You're going to lose, guaranteed. Because what really drives markets are humans. What humans do is react to emotional stimuli. And the people that run this business, the business of the stock market, they are well aware of what the average person can and cannot take. And they have the pocketbook to make that happen. That's the end of my speech. Let's get into it. So what do we want to look at first? I say oil, because oil has been looking like a fun place to be right now. So let's go up here. Let us take a look at oil. I'm going to zoom out to the monthly chart, as I always do. And let's take a look at what oil has to offer. Oh, we're going to have to zoom in. This is gosh, this was such a great run. I had so much fun during this. I mean, this run right here was one of the easiest runs ever. I remember this. This is where it pulled from like 58 to 44. And I had people, I was in a martial arts dojo at the time. Oh, what about that pullback? I go, oh, you better be buying the farm there. I started buying into this thing. I forget where it was. It was somewhere around 31, 32, and just rode this thing up into like 91. And then I finally I sold out. See, it's funny. Oh no, here it is. It goes even higher. So it's saying the high is 92.20. I'm sure that's correct, but we sat up in this 90s area for 4 or 5 months as I was scaling out of my positions, which, by the way, is another thing that you would better know how to do if you consider yourself a serious market participant, investor, trader, what have you. If you do not scale in and out of positions, this is going to be a very tough existence for you. So if you want to know how you knew that you should be in oil, if you look down here after like a 80% fall in price, you had the largest volume you'd ever seen. How did you know to get out? Well, basically the same exact way. You got up to 92, and it was just as blindingly obvious what you should be doing. Here it is right here. What is that? What's the price up there? What's the high? The high of 87.84. If you didn't start scaling out here, you don't know what you're doing. Plain and simple. Okay, let me get rid of those 2 arrows. But that's how you knew where to buy, and that's how you knew where to sell. It is not a difficult thing to do. And then along the way, as you break down charts, as you break down time frames, depending on how active of a trader you are, there were a lot of in and outs in oil. There were a lot of in and outs. It was really, really fun. And it looks like we're seeing some of that again. So let's see, because we bounced from 84, 85 down to 69. And this range is an interesting thing. And I've talked a lot about this range. So let's go ahead and zoom in on this range. This range exists to either build up steam to drive much, much higher or to fall. Now the average guy on the internet's going to go, look, see this range? This has been so easy. This is your high price. This is where you sell. This is your low price. This is well, probably hopefully they understand that's the real range. But even though you have some prices popping out, hopefully they understand why those don't count. But this is the range. Right now you're in the middle, right? So it's like you go up, you go down. That is not how it works, by the way. So I hope you don't actually believe that. Um, boop, within ranges are used to build, or they are used to, when I say build, they're the professional traders and institutional traders, the more knowledgeable hands, are buying up a position, and they're creating fear within that position. So in this case, oil, so they can buy more, or they're selling off that position, and that means that they are trying to create FOMO, that you feel you're going to miss out. You're missing out. You're missing out. There it is again, to get retail to buy so that they can sell. Because look, when retail is buying, institutions are selling. When institutions are buying, retail is selling. It's like Warren Buffett says, I buy when there's blood in the water, right? What he means by that is when fear is at its highest, he is the most interesting in purchasing. And as you can see up here, this is selling at 84, which is where the selling has been occurring. Now, this right here, as you can see, the interesting thing here is the lack of volume. What does a lack of volume mean? Well, first off, it's July 2nd, July 5th. So you're going to want to pay attention to the fact that it's before and after the July 4th holiday. But what that does mean is there was no interest in prices at this level, and they did not have the amount of supply necessary to drive through the previous high price. So prices pulled back down. Now, what you would look for down here would either be very high levels of volume like this back here, because if you see a very high level of volume down at the lows, which is right now about 65, I remember we bought back in somewhere around 56 and have been playing oil ever since. And that is my DCA. That is where I dollar cost average back in was about $56 after selling up there around 90. And my original purchase price was down around 30. Right now, what you're going to look for is as it returns down here to the 65 to 70 level, which we were in. I think we were in the 70 level yesterday. Yeah, we were. Once you're in the 65 to 70 level, you want to see if you can get a massive piece of volume, institutional volume, like this right here. Here, let me just point to it. If you can get a big, large piece of volume like that right there out of the institutions, well, I can tell you now that what you're going to be looking at is a huge price move. If you don't get that, because this right here, this institutional buying that took place created this price run from 67 to 83. All right. So, and then at 83, what happened? Look at 83. Look. There's the selling of the buying, right? So you bought here, you sold here. You created some FOMO up here, you sold off to retail. Down here, you created some fear, you bought some from retail. It's pretty straightforward. And yes, you can forecast that. You don't have to wait for it to happen to then assume. Now, as price comes back, I would call that semi-significant volume there. There's probably one of 15 places where trading activity was this high within how long is this? About a year. Yeah, about a year. Let's zoom in a little bit more. Let's take a look at what's going on now, because that's really what we're interested in. So as we look at this chart, do we see a lot of gaps, and we see those gaps filling? Yeah, listen, in commodities, you're going to see a lot of gaps. That's a snappy price move, right? It just is. That's what it is. And so it'll generate a lot of gaps. So you want to watch and you want to pay attention when you're looking at commodities, what you want to focus a heck of a lot more on is the trading activity and where that trading activity is taking place. So here you're looking at what, $75? What's the low? The low there is 73, 74. You got to run to 79. Is that insignificant? Is $5 insignificant? In this particular position, I don't know. I mean, 3.5%, I guess. I don't know if it's insignificant or not. Here you have a bunch of activity in the same place. Now we're getting down here into the 69.70 level, and you're having that same level of trading activity occurring down here at low prices. Let's zoom in a little bit more. What's this price level here? 74. This trading activity doesn't look as significant, but if you look back here, you'll just see like a tower kind of popping out of nowhere, right? Like there's not a lot around it. It's like looking at a small town, like looking at some place in the valley. Like you're looking in the valley and there's one big tall building back here. But over here, you're starting to see a pretty sizable cluster, and volume is picking up, aka trading activity, aka cash flow, as you reach these low prices. And it's happening in a larger amount. And look at this. All right, let's zoom in a little bit more. Let's see if we see something. And with a commodity, just because commodities are extremely active does not mean, and they generate huge gaps, that doesn't mean that you have to play that game, right? You can play this over the longer term if you want. Now, if you're doing that, is now a time to buy? Well, no. Why not? All right, well, let's go look. By the way, on this 5-minute chart, you're probably looking at two pretty substantial price targets here. You have one there. You have one here. Right? Because gaps are filling. And first, it looks like you have to come back down to about 69.50, which is what? $1.50 away from where you sit now. But you do have two pretty substantial price targets here. This one's up at like 70. Just call that 76. This one's at 74. Oh. This one's at 74. You're on a 5-minute chart. So you should be looking at what? The next week. So usually or traditionally, this is nothing more than 2 to 3 days. Right now, we're still, the 5-minute chart's still looking at 2 to 5 days. It just is. That's the way it's running right now. I don't know why we're having this kind of muted response to things, but we are. So you're probably looking at 3 to 5 days here. Your downside is right here, which is about, what is this? 69, 65. This is your downside. Hold on, let's do this. Let's do 3 to 5 day upside target. Well, we're going to go ahead and change this back to blue. So that you know that it's an upside target and it's not to be confused. This is the same. This is a 3 to 5 day upside, 3 to 5 day upside target. And this right here is your downside potential right here. Now, you should know how to play this, right? So you don't have to be, and by the way, you don't have to be correct in the order in which all of this happens. You don't need to know the order in which it happens. You can see this. Now, is this even worth it to you? From 70.88 to 69.65, do you even care? Some people, they do. Well, absolutely they care. Some people care a heck of a lot about a move like that. This is what we are 9.5. On USO. Some people could care less. Some people could care less about that. That means nothing to them. That little move, if anything, they'd buy more, right? But for some people, it does matter. And it would certainly matter if you get up into 74 and 77 and you haven't revisited 69. If you short, and you would evaluate it at that time, you know that target doesn't go away. It's not like because it doesn't go there first, all of a sudden it was meaningless and that target goes away. No, that target's a target. But what you have to know is, how do you invest? How do you trade? If you know the answer to that, then you know exactly what to do right now. Because there's your answer. Look, this is what's going to happen right here. This is what's going to happen. Now, how you manage this and how you handle this depends on how you invest and how you trade. What size should your position in oil be? What's your bias? Is it to the upside or the downside? I would certainly hope in energy your bias is to the upside, like from like an omniscient perspective. But what is your bias right now? So you're looking at this. What's your bias? Which direction do you see oil going? So if we pull up a daily chart, we can even pull up a weekly chart, because a weekly chart would be 2 to 5 years. So if we pull this up, is your bias to the upside or downside? Is volume telling you anything? Let's get rid of that cliff in the back, because that makes it really hard to evaluate what's going on right now. Is there anything going on right now that leads you to believe that it should go higher or lower? I mean, you're effectively in the middle of a very active range, right? Say from 83 to whatever I said down here, 60. 83 to 60. You're sitting at 70, 71. You're right in the center of a very active range. What should you do right now? Maybe what you should do is nothing. Oftentimes, you wait. If someone asked me what to do right now, I would say it's based on your time. What's your time frame? You're a swing trader, you're a day trader, you're a long-term trader. What are you? Because that's what's going to determine what you should do right now. How long is it taking to go from the base, from trough to peak, basically, right? So if you're at 60, this is June of 23. This is September of 23. June, July, August. This is the end of September. So 4 months. How long did it take here? From beginning of December, mid-December to April, 4 months. And you made a higher low. You didn't make a higher high. You touched the high again. If it were to reverse here, what would it look like they were doing with this range? They're building steam to go higher. I would agree with that, by the way. They're building a position to go higher. I would completely agree with that. I think that is absolutely what's going on in oil. I would most definitely have an extreme bias to the upside. I think that's where it's headed, for sure. Would I have a problem buying now? No. Based on what I do, I don't have a problem buying now. That's fine with me. But is it fine with you? I don't know. All right, so that's oil. Let's take a look at gold. Gold is something else that's been really interesting, because I think gold bugs still fail to realize that gold is nothing more than a yellow metal. It's not tied to a currency anymore. It doesn't really have much reason to go higher. You can say that it's for safety, but it's not. I mean, every time the market pulls down, gold pulls down. I mean, here you are in 2020. This is before the 2021 fall, but not very much before. And you went from, where's 2021, by the way? So if you go to November, December of 2021, it's right here, January 22. So you're sitting at 172. This is probably the low, November of 22. And you're at 150. You lost 22 points on 170. 11. You're looking at an 8% drop. Did it fall less than the market? Yes. Did it offer real safety? No. It broke out to a higher price. It then revisited the previous high price within the range. Now it's gone higher. So you should, if you even cared about this, you're still sitting here waiting for 180 before you'd ever buy it. There's no volume here that indicates it's going to go higher. In fact, there's volume here that indicates it's going to go much, much lower. If you're an intelligent investor, are you buying gold right now? No. I mean, you're bare minimum waiting for 180. And I've been saying this for quite a while. And let me tell you something. I am a patient man when it comes to markets and when it comes to investments. I am a very, very patient man. I will not make a mistake, period. Just because the world says that this is good does not make it good. And this isn't good. This is not good. You should wait for 180. If you look here, what happened? You had a range, and what was this? This is 163, right? That's kind of mid-range. What was the high here? Where you were generating some of the highest volume on this chart. What's the high price? 194. So you had 30 points. So not 15, not 12. So it rolled 10% higher to 192, and then it fell down to 150. So it fell 40 points, roughly 20%, little more than 20% from these high prices. Of course it did. It had to come back into this range, just like it will here. Just like it will here. But let's zoom in on gold. Let's see what's going on here. This is almost a price at which you would say, I mean, it's November of 22 through now. I mean, you're looking at 2 years of a price move, but this is, gone up very quickly, especially for gold. Let's take a look at from here. What's this? February 24. This is this year where it went from 185. Why? Because there's a lot of computer trading. There was a breakout of the high price. So computers bought, hence this volume right here. But guess what? This looks like a lot more like selling than it does buying at 225. And an intelligent buy point here is not prior to 180. If it doesn't pull back, so what? Get into something else. But that's all we're doing right now. We want to evaluate this run up. How healthy does this run up look? Well, this high price right here of 224.88, it has a high price of 225.09, has some of the highest volume on this chart. As you come over, does this look like it has a substantial increase in volume? I wouldn't call it substantial. It certainly had substantial increase here, a very substantial increase. Now, let me ask you a question. When institutional money transitions money over to retail, what traditionally happens? Do you know what traditionally happens? Well, you can ask anybody that works with a financial advisor what happens, say 10 years ago. Most advisors don't even give stock picks anymore. They don't even offer stocks. They only talk about third-party institutional like mutual funds, third-party money managers. Most of no, that's not true. There are quite a few that do ETFs and ETNs. But bottom line is they're not giving you single stocks anymore for the most part. But those of you that were around 10 years ago, what happened when your broker advised you to buy a stock? You get a nice run up of 5, 6, 7%. Then what happened? It would fall 20 to 30%. Why? Because their trading desk offloaded the stock to you, and then the stock fell. Once institutional hands have no more use for holding something higher, it drops. So is it unreasonable to believe, looking at this volume, looking at the trading activity that is absolutely outrageous on this chart? This is an outrageous level of volume at 225.09 on gold. Is it wild to think that perhaps that was the beginning of the transition institutional hands to retail hands? Because price has risen 7 points. It's risen 3%. So this is evidence that this was not selling. No, this is evidence that this was selling. That's what that is. That is evidence of selling, not buying. As we come in, what do we see over here? Anything, like I said, with commodities, we are far more interested in trading activity and volume than we are in gaps, because commodities create tons of gaps. Gaps can be used as price targets as you really zoom in, because they do fill. But when you're looking out like this, you're not really going to be using gaps as price targets on a daily chart or a 4-hour chart. Trading activity back here looks pretty substantial. Right here, this looks like some substantial trading activity, right? But I wouldn't say right now it does. I wouldn't say over here. If anything, I mean, it's lackluster. It's falling off. The only possibility right now would be that there is no interest in buying at these prices, which is not very good for gold. But let's take a look. Let's look here. So you're creating a small range up here. Remember, every chart is a new picture. It's a new story, and you have to treat it as such. As I said, as you begin to zoom in, you can start looking at some gaps, and we can see where some bad behavior began around 220, and it's carrying itself from 227 into 229, but it reversed here. It filled. You see this gap fill. Did this gap fill? No. Does it absolutely have to? Well, we're on a 1 hour chart. That's still a little long to use gaps as targets in commodities. But would I say that this matters? Yeah, but that's only down at 220. We saw some substantial selling at 225. This, again, this looks like a cluster of volume to me, sitting up here to range from what? 228 to 233, 234. That's where all this volume lies, right here. So in this picture, in a 30-minute chart, you would say that there is some substantial volume at that high price. I would say that there is some more here. And what we're looking for, as you should know, if you watch me, or if you've been watching me, or if you haven't, let me tell you that when you zoom into charts, what you're really doing is shortening your time frame. This shortens the time frame for which you would hold any security. So as you get into a 5-minute chart, that's like right now it's a 3 to 5 day hold. Traditionally, it's a 2 to 3. You get out into 30 minutes, 4 to 6 weeks. As we go down to 15-minute chart, you're looking at 2 to 3 weeks right now. This is a 2 to 3 week forecast. What do we see? Did this gap fill? Yes. There's a gap down. Did it fill? Yes. Now there's a gap up. Has it filled? No. So you're looking at right now, you're looking at the next couple of weeks. What do you see here? Well, you see a target down at 230. You're sitting at 233. We'll zoom into a 5-minute chart. This is a 2 to 3 day outlook on this particular commodity. And what you have is you do have a nice target down here at 230. So building into that short over the next 3 to 5 days is not a bad idea. Short term, right? If you're short term, this makes a lot of sense for you. Let's do USO. But as we walked through USO just now, what do we realize? Well, we realize that there is a ton of selling down at 225, right? And we're sitting at 233 now. Target date. And also, if we look at where it broke out from, there's a target price down there at 174, 180 that will be met at some point. Or if it's not, this is not worth something buying into, not to the long side. Long side meaning buying. You're looking for the price to go up. Target date. What did I say? We're going, well, this right now, sadly is 3 to 5 days. You have to go out 5 days from now. Today's the 5th, so you have the 6th. So you have 9, 10, 11, 12. Yeah, you're looking at the 12th. 9, 12, 20, 24. Get out of here. 9, 12. We'll make it. I mean, it's not going to take that long. Nine, 10. It's got to make it here in 2 days. Well, that's 3 days away. 2 days less than 5 days. So let's go ahead. So now you've walked through gold, right? So what you should know, having done that, what you should be aware of after we have just walked through that, you should see that there should be a downside bias on gold, right? I'm not telling you FOMO can't kick in, that the preppers can't go crazy and say the world's going to end and this thing takes off. But what I can tell you is that you wouldn't want to own it. And if you short right now, you have a good short-term downside target. You can see that there's a ton of selling at 225, which would lead you. That could institution selling there. And a good downside target is 180. But if you're going to play it to the downside, this is where you start. You would start with a price target of 231 over the next 3 days. And then you would reevaluate. That's what a lot of people, they don't realize, is that you are consistently reevaluating this stuff. You're never just holding things forever. It doesn't work like that. If you're doing that, you're making a big mistake. You don't hold when you see your opinion can change. Now, If you are swing trading or day trading, you're active in the market. You're at least looking at it each day. Doesn't mean you're doing things every day, but you're at least looking at it each day. So you're aware of these changes. If you're someone who's like, hey, I look at it once a week, I get my setups on Sunday, then you're someone that right now wouldn't be involved in this to any degree unless you were starting to create a longer term downside target of 220. I hope that makes sense. Let's take a look at TLT. This is something that I began buying at 91.80. We did some selling up at 100, and then we did a little bit more buying. But let's go take a look. So here we are at 100. TLT, by the way, if you want to know what your long term on this is, would you call this a substantial amount of trading activity? I'm just curious what you call that. Yeah, clearly you'd call that a substantial amount of trading activity. How far has this particular position fallen? Oh, only 50%. So let me ask you a question. Do institutional traders buy or sell at a low price? What do they do? What is the answer here, everybody? Right. Price has fallen. Price has fallen 50%. So if you are a long-term investor in the market, if you buy and hold, so to speak, this would have been a disastrous buy and hold for you. This would have been, and by the way, it's treasuries, so these are less risky. These are safer. You work with an advisor, this is much safer. It's safe. It's the 20-year treasury. It fell 50%. And right now it's really risky because we're in an interest rate. Interest rates are volatile right now. This is risky. This is why you can't speak on typical risk parameters if you're active at all. And if you're not active, you're making a huge mistake. In my opinion, this is the safest asset you could buy right now. There's nothing safer. It was the riskiest asset you could own coming into 2020. It's a 20-year treasury. Risk is relative to the environment that you're working within. Always. Not sometimes, always. All right, I'm going to stop the share there. I've been going for about 40 minutes. I'm going to get into some of those other positions tomorrow. As always, I want to thank you all for joining me. I really appreciate it. I hope you enjoyed it. I hope you learned something. I hope this helped you. That's the goal of these videos. That's why I make them, to help educate you, to help teach you, to help you learn, to see through the eyes of somebody who's been doing this for 25 years. And really, I mean, I just have my intuition with this stuff now far exceeds the need for mechanics because I've been doing it so long. It's like anything you do for 25 years, it just becomes you and you become it. And so because of that, I have a way that I can explain this to you that makes sense to a human being because we operate on emotions. And that's how markets operate, not on mechanics. Mechanics are part of the business of the stock market. The business of the stock market. And those mechanics are used against less knowledgeable hands and retail traders every chance they get. And that's why so many guys make so much money in up markets and then they lose it all in down markets. They lose it all and then some, or they lose most of the profit, whatever. As always, thank you so much. If you're not good up here, you're not good anywhere. Get outside, see the sun, go for a walk, smile like an idiot for an hour. If you're having a bad day, it will work. Listen, you've never lost. You're still winning every single day. How do I know that? Because you've never failed. How do I know that? Because you're still. Remember, every day above ground is a good day. Thank you so much for joining me, and I'll see you.